Safe haven characteristics, that's how you describe Chinese assets. Do those safe haven characteristics evaporate in the event of an escalation in these tensions?
Good morning, gentlemen. I think, over the last 2 years or so, we've seen short-term volatility because of the geopolitical tensions, but over the medium and long term, it actually has been a pretty good haven in many asset classes, whether you talk about FX, rates, credit, equities. When we look at even the first half of this year, for example, renminbi assets have been extremely stable, actually, compared to both emerging markets and developed markets. I was just looking, even with the recent weakening in the renminbi, it's only depreciated 2.5% against the dollar this year. If you compare it to the other BRICS currencies, the Brazilian real is down 25%, Russian ruble is down 12%, the South African rand is down 20%. So it's really, China is acting really more like I would say it's like an emerging developed country rather than an emerging market anymore. And to be very interestingly, I think part of the story is that the PBOC, the Chinese government, has not done what the Fed or the ECB has done. I think when the coronavirus, when COVID-19 became pretty serious in February and March, the Fed, they kind of went all in and lowered rates in two big fell swoops to pretty much zero. ECB did similar. QE increased a lot. PBOC held very steady, actually. Rates have come down a little bit, but not nearly as much. So what you have now is a very interesting dynamic. You have countries like Germany, France, Switzerland, Japan. The 10-year government bonds there are all either negative or zero. 10-year CGB is at 2.7% basically. So it's the biggest differential in about 10 years, about 200 basis points between, let's say, the 10-year CGB and 10-year treasuries. So it's actually a pretty interesting buying opportunity. So in terms of the Sharpe ratio, the yield adjusted for volatility, it's pretty good relative value. And also, what we see is that the dollar CNY cross-currency basis is also attractive. It adds another 55 or 60 basis points if investors buy the renminbi and swap into dollars. So what we've seen actually this year is a pretty significant inflow into the China onshore bond market, about 180 billion renminbi from offshore investors. So the turnover increased about 30% year on year, quarter on quarter on the offshore investors' investments into the Chinese bonds. So that's quite interesting. Now on the
George,
go ahead.
George, let me just ask, in terms of those inflows then to the bond market, where is that being directed? Are they looking at policy banks? Are they looking at the sovereign notes? Where do investors want to be positioned in the bond markets here? Where are the greatest opportunities?
Good question. About 75% of that flows has been into the rate bonds, so CGBs and development bank bonds like CDB. So I think they view that that's a pretty good relative value on a sovereign basis or quasi-sovereign basis because of the 200 basis point differential. But even on the AAA high grade, very high grade corporates, so kind of the quasi-sovereign SOE names, that's also relatively attractive, mainly because the U.S. dollar market and the euro market, they printed so much, and with the overall yields coming down so much overseas, even the AAA, the true AAA credits actually look pretty attractive onshore, but that's only about a quarter of the inflows.